So, how does a company sell fewer products, face this terrible construction market, literally freeze their operations for weeks, and then, somehow come out making more profit per share?
It sounds impossible, honestly.
Right. But today, we're opening up the financial playbook of a company that actually pulled this off. Welcome to the deep dive. For this one, we're looking at Carlisle Companies, ticker symbol CSL.
Yeah, and to kind of set the stage for you, if you're building a physical house, you want a roof that can withstand a hurricane, right?
Wow.
Like you over-engineer the trusses, you invest in impact-resistant materials. And what we're really doing today is looking at how a company builds a financial house to withstand, well, an economic hurricane.
I love that analogy. And that's exactly what makes this interesting, because we aren't just looking at a dry spreadsheet today. We are breaking down how a major building envelope and materials company navigates, soft markets and this really stubborn inflation.
Which is tough.
Super tough. The natural expectation when an industry faces that kind of pressure is that profits will just crater. But Carlisle's first quarter of 2026 tells a completely different story.
It really does. And to grasp the mechanics of what they actually did, you have to look past the top-line revenue. I mean, the overarching theme here is operational efficiency and incredibly disciplined capital allocation.
Right.
Because when the macroeconomic environment turned hostile, their underlying foundation is what protected the bottom line.
Okay, so let's get right into those surface level numbers, because they immediately raise some red flags for me.
Oh, for sure.
In the first quarter of 2026, Carlisle generated $1.1 billion in revenue. Now, that represents a 4% drop compared to the same time last year.
Yeah.
And if you strip out currency fluctuations and their recent acquisitions to look at just the organic revenue, it was actually a 5% drop. So the top line absolutely took a hit.
Definitely.
But their adjusted earnings per share, their EPS, actually grew by 1%, landing at $3.63.
Right. So they moved less product, but squeezed out more earnings per share.
Which, honestly, it makes me skeptical.
I don't blame you.
Yeah, when a company sells less but magically makes more per share, my first instinct is financial engineering.
Yeah, the old Wall Street magic.
Exactly. It sounds like they just bought back a ton of their own stock to make the math look good on paper.
Right.
Like, if I bake a smaller pie, but I just cut it into 3 giant slices instead of 8, I haven't suddenly become a master baker.
Right. It's a super common assumption. And to understand what really happened, we have to break down what's called the EPS bridge. Now, share repurchases did play a significant role.
Okay, so they did buy back stock.
They did. By buying back their own stock, they reduced the number of shares outstanding, which mathematically added 29 cents to their earnings per share. And honestly, they absolutely needed that buffer.
Because the core business was shrinking.
Exactly. Their organic earnings dropped by 6 cents a share just due to lower volumes, and then higher net interest and taxes took another 18 cents out of the mix. So yes, the buybacks did a lot of the heavy lifting to keep that final EPS number in the green.
So wait, it was just a stock buyback masking a shrinking business then?
No, not at all. And here is where you have to look at how efficiently the core operations were running. The metric that tells the real story here is their adjusted EBITDA margin.
Okay.
EBITDA, so that's earnings before interest, taxes, depreciation, and amortization. It strips away all that accounting noise and shows you the raw profitability of the everyday business. And even with that massive drop in revenue, their adjusted EBITDA margin expanded by 50 basis points, coming in at 22.3%.
Okay, for anyone listening who doesn't speak Wall Street, 50 basis points just means half of 1%, right?
Yes, exactly, half of 1%. And it sounds like a rounding error, but when you're dealing with $1.1 billion in quarterly revenue, expanding your profit margin by 0.5% while your sales volume is dropping, that is a massive operational victory.
Wow, okay.
Yeah, it proves this wasn't just a mirage built on stock buybacks. They genuinely extracted more profit out of every single dollar that came through the door.
Well, the obvious question then is how? If fewer dollars are coming in, how are you keeping a larger percentage of them?
Right. So the underlying engine behind this is something they call the Carlisle Operating System, or COS. It's their framework for continuous productivity improvement.
Like finding efficiencies anywhere they can.
Exactly. Because when demand slows down, a poorly run company just watches its profit margins collapse. But a highly disciplined company uses that slowdown to ruthlessly eliminate waste on the factory floor. Yeah. They optimize their manufacturing processes to require fewer man-hours per unit. They exercised incredibly strict procurement discipline, which basically means they probably went back to their raw material suppliers and negotiated way harder on costs. and they kept a really tight lid on selling and administrative expenses.
So they ran a tighter ship. But we've established they did that to protect their margins because the revenue was still shrinking.
Right.
And that operational discipline doesn't just exist in a vacuum. The external environment was throwing up roadblocks they couldn't really control. And the first major headwind was literally the weather.
Oh, yeah. It's so easy to forget when we're talking about billions of dollars in financial margins that this is fundamentally a business tied to the physical world.
Yeah, you're literally building things outside.
Right. You can have a perfectly optimized supply chain and this incredible sales team, but if there's a foot of ice on a commercial rooftop in Chicago, a contractor cannot safely install a weatherproofing system.
The work just stops.
It simply stops. The harsh winter weather in Q1 severely limited contractors' days on the roof, which, creates this massive bottleneck for Carlisle's products.
So the weather put the brakes on installation. But the weather wasn't the only reason their year-over-year revenue comparison looks so bad, right? They were also dealing with a massive hangover from the previous year.
Yes, the ghost of tariffs.
Right.
If we rewind to the first quarter of 2025, Carlisle saw a $15 million artificial spike in orders. And this was a direct result of customers anticipating upcoming tariffs.
It's just the psychology of purchasing managers. Like, if a manager knows that a new tariff is going to make building materials 10% more expensive next month, they aren't going to wait.
Oh, absolutely not.
They'll just blow through their entire quarterly budget immediately to hoard inventory at the lower price.
Exactly. And that pull forward makes the current year look terrible by comparison. Q1 2025 was artificially inflated by panic buying, which means Q1 2026 had to overcome this unusually high baseline just to break even.
Okay, so it's like trying to run an ice cream shop during a blizzard, combined with the fact that all your best customers already bought extra ice cream last month because they thought the price was going up.
That is the perfect analogy. And you add in the continued softness in the broader commercial and residential construction markets, which is driven heavily by high interest rates, making new building projects incredibly expensive to finance. And you have this trifecta of downward pressure on sales.
But despite all of that, the blizzards, the tough comparisons, the stalling construction market, they still managed to successfully announce and implement price increases to offset their own inflation costs.
Yeah, which is huge.
Right. Raising prices when your market is soft and projects are delayed is a massive indicator of pricing power. It tells you their customers don't view these materials as optional.
Exactly. Think about it. When a commercial property management firm has a leaking roof on a massive distribution center, repairing that building envelope is not a discretionary expense.
You can't just ignore a leaking roof.
No, you really can't. They can delay breaking ground on a new facility, sure, but they have to protect the assets they already have. That inherent necessity allows Carlisle to pass along inflationary costs without destroying their customer base.
Which brings up a really important distinction because Carlisle operates in a few different spaces. They aren't just one giant monolithic factory.
Right.
To understand how they survive these headwinds, we have to look at their two major segments because the data shows they performed very differently. First, there's Carlisle Construction Materials, or CCM.
Yeah, the big one.
Right, this is the absolute workhorse of the company. It generated $758 million in the quarter. Revenue was down 5%, but their adjusted EBITDA margin actually grew by 30 basis points to an impressive 27.4%.
And the core driver keeping that segment highly profitable is recurring re-roofing activity.
Because roofs don't last forever. Even if nobody is building new office parks, the buildings built 20 years ago still need maintenance.
Exactly. That existing installed base acts as a massive financial shock absorber. New construction is totally cyclical. It booms and busts with the overall economy. But re-roofing is driven by time and the elements.
It's inevitable.
It is. It provides this baseline of recurring revenue that keeps the CCM segment throwing off cash even in a downturn.
Okay, so then you look at the other side of the business. Carlisle Weatherproofing Technologies, or CWT. Now, this is a much smaller segment, pulling in $294 million. Their revenue only fell by 1%, which honestly sounds better than the larger segment.
On the surface, yeah.
But their profit margins took a hit. They shrank by 40 basis points, down to 15.2%. And the stated reason for this margin compression is, quote, deleverage on lower volume. We need to unpack what that actually means on a factory floor.
Sure. So think about the physics and economics of running a massive manufacturing plant. A facility has enormous fixed costs that exist whether you make one product or 10,000. You have to pay for the building, the property taxes, the heavy machinery, and just the baseline energy required to keep the lights and the climate control running.
Yeah, the machines don't really care if the economy is soft.
Exactly. They cost the same to run. When demand is high and you're running that plant at 90% capacity, you're spreading those massive fixed costs across thousands of units. The cost burden on each individual product is relatively small, which means your profit margin on every sale is high. That is leverage.
Okay.
But when demand slows down and you're suddenly only running the factory at, say, 70% capacity, those fixed costs don't shrink. You still have to heat the building and pay the property tax. But now those same costs are spread over far fewer products.
Oh, I see.
Yeah, so the cost to produce each unit mathematically goes up and your profit margin gets squeezed. That is deleveraging, and it is incredibly dangerous for a manufacturing business.
It costs almost the same amount of money to run a factory half empty as it does full. So the moment volume drops, your margins just evaporate.
But management didn't just accept that margin hit passively. Within that CWT segment, they actively pulled levers to stop the bleeding. They finalized strategic acquisitions, specifically bringing in companies called Firmafoam and Bonded Logic.
Okay.
And they executed what they call footprint reduction synergies.
Which is corporate speak for shutting down redundant operations. Like when you buy a competitor like Thermofoam, you don't keep both sets of warehouses open.
Right, you consolidate.
You merge the shipping routes, you shut down the least efficient factory, and you aggressively lower those very fixed costs we just talked about.
Exactly. And beyond the factory floor, there's a fundamental shift in what Carlisle is actually selling, which kind of explains why their customer base is so loyal. This isn't just about rolling out hot tar and black shingles.
Yeah, when you look at modern commercial architecture, you realize the products they're building are highly complex. They're engineering massive, ultra-modern green roofs.
Right.
We were talking about literal vegetation systems built on top of high-rise buildings, paired with highly reflective white weatherproofing barriers.
Yeah, the industry calls it the building envelope. These systems are designed for advanced thermal efficiency because a massive commercial structure loses an unbelievable amount of money if its heating and cooling systems have to fight against a poorly insulated roof.
Oh, for sure.
So Carlisle is engineering these multi-layered systems that drastically reduce the energy footprint of the building beneath them. And because these systems are so technically complex, they create an incredibly sticky relationship with the customer.
Right, because if you're managing a high-tech green roof and it needs a partial retrofit 10 years down the line, you don't just hire a random contractor with a pickup truck.
Definitely not.
You have to go back to the manufacturer whose engineered system is already integrated into the structure of your building.
You're locked into their ecosystem, which basically guarantees that future re-roofing revenue goes right back to Carlisle.
Okay, so the operations are tight, the customer base is sticky, and the margins are protected. But a company can have fantastic margins and still completely collapse if its balance sheet is a mess.
Oh, 100%.
We really need to look at their financial war chest. Because survival in a tough macro environment ultimately comes down to cash and debt.
The balance sheet is what separates the companies that are genuinely resilient from the ones that are just getting lucky.
Which brings up a number from the first quarter that usually sets off major alarm bells for any investor. Carlisle's free cash flow in Q1 was negative $73 million.
Yeah, that sounds scary.
Right. Seeing a negative cash flow number immediately makes you wonder if the business is bleeding out. But when you dig into the mechanics of their industry, it looks entirely seasonal.
Okay.
It's like buying inventory before the summer rush, almost like a farmer spending a fortune on seeds and fertilizer in February. The bank account goes negative, but they have to do it so they're ready for the massive spring planting season.
That's exactly what it is. The seasonal working capital cycle is a defining feature of the construction materials industry. That negative $73 million in cash flow isn't a loss. It's a planned buildup of inventory. They spend the first 3 months of the year when no one is installing roofs anyway because of the winter weather manufacturing and stockpiling product. Then, when the ice melts and contractors get back to work in the spring and summer, Carlisle has the materials ready to ship instantly.
Right. Because if they didn't do that,
If they tried to run a perfectly balanced cash flow in Q1, They simply wouldn't have enough product to sell during the peak season.
They're just stocking the shelves. And it completely stops being a concern when you zoom out and look at their total liquidity.
Right.
They are sitting on $1.8 billion in available liquidity, which includes $771 million in raw cash on hand. Like a planned seasonal dip of $73 million is practically nothing when you have a $771 million cash cushion.
The cash provides the safety net, definitely. But the most brilliant part of their financial structure right now is actually how they manage their debt.
Oh, yeah. Let's talk about the debt.
Because the broader macroeconomic environment today is defined by stubbornly high interest rates. Companies that took out short-term, cheap debt 3 or 4 years ago are suddenly having to refinance that debt at current rates.
And getting crushed by it.
Exactly. The new massive interest payments are just destroying their cash flow.
But Carlisle's debt profile is incredibly defensive. Their net debt to EBITDA ratio is 1.7x. And for anyone keeping track, that simply means if they took all the profit they make in a year, it would take them less than 2 years to completely wipe out every single dollar of debt they owe.
Right, which is super healthy.
That ratio is well within their target range of 1.0 to 2.0x. It gives them massive breathing room. But the real competitive advantage is the structure of the debt itself.
This is my favorite part. Across all their outstanding debt, their weighted average interest rate is locked in at just 3.8%.
Wow.
And the average maturity of that debt is 6.6 years away.
That is wild. It's the corporate equivalent of having a fixed-rate mortgage from 2021. While every other company in the sector is struggling to finance operations at 7 or 8%, Carlisle has a locked-in rate of 3.8% for the next 6 years.
They are almost entirely insulated from the current interest rate volatility. And think about it. The cash they save on interest payments every single quarter can be redirected into research and development, facility upgrades, or further acquisitions.
It's a huge advantage.
It is that cheap capital acts as a massive competitive moat that their rivals simply cannot replicate right now.
And that structural advantage is exactly why management can look at a tough quarter with revenue down and weather-delaying projects and still confidently reaffirm their long-term guidance.
Yeah, they didn't blink.
Looking ahead to the full year 2026, they are still projecting low single-digit revenue growth. They still expect to expand their margins by another 50 basis points, and most importantly, they expect their return on invested capital, or ROIC, to exceed 25%.
And if you're analyzing a company's fundamental health, ROIC is really the metric that reveals the true quality of the management team.
Let's break that down for the listener. Return on invested capital basically measures how good a company is at turning a dollar of investment into actual profit.
Right. When management takes capital and deploys it, whether that means buying a competitor like Thermofoam, upgrading a manufacturing plant to be more efficient, or launching a new line of thermal barriers, an ROIC of over 25%, means they are generating an elite return on that specific investment.
So they aren't wasting money.
Exactly. It proves they aren't just empire building or buying companies for the sake of getting bigger. They're only deploying cash into projects that generate verifiable, high-yield value.
So to bring all of these moving parts together for you, true corporate resilience is not about magically dodging macroeconomic storms. Every company in the building sector had to deal with the harsh winter. Every company had to face the soft commercial real estate market and high interest rates.
You can't control the weather.
You really can't. Resilience is about the internal mechanics. It is the operational discipline of the Carlisle operating system, relentlessly squeezing waste out of the factory floor. It is the strategic M&A execution, buying up competitors to consolidate facilities and lower fixed costs. And it is the foresight to build a rock-solid balance sheet, locking in cheap, long-term debt, so that when the external environment turns chaotic, your bottom line is fundamentally protected.
And, understanding how they built that resilience leads to a much bigger question about where this entire sector is heading.
What do you mean?
Well, if you look closely at how Carlisle positions its long-term strategy, they heavily feature their corporate net zero commitments right alongside those advanced thermal building envelopes and green infrastructure systems.
Right.
As global weather patterns become more extreme and as energy efficiency mandates for massive commercial buildings become increasingly strict,
It changes the definition of what they actually do.
it does. It raises the question of how the market will eventually categorize them. Will investors continue to view companies like Carlisle strictly as traditional construction material suppliers, tied directly to the boom and bust cycles of building new structures? Or will the market begin to recognize them as essential climate adaptation technology companies?
Oh, wow. From a roofing materials company to a climate adaptation tech company. Because if a building owner has to retrofit their facility just to comply with new climate regulations and energy costs, Carlisle isn't just selling them a roof, they're selling them the compliance and the efficiency.
Exactly.
That psychological shift completely alters the ceiling for how a company like this is valued. And that is exactly why we tear apart these earnings reports. Because the best knowledge doesn't just tell you what a company made last quarter. It fundamentally changes how you view the infrastructure all around you.
Thank you for joining us on this deep dive. We'll catch you next time.